$87,685 every second, not every hour, not every day, every single second that passes while you are watching this video. That is how fast the United States national debt is growing, according to US Treasury Fiscal Data as of April 23, 2026. By the time this sentence ends, the number has already moved. By the time this video ends, the national debt will be higher by approximately $1.8 million. And almost no one in your social circle is talking about what that number means for the money sitting in their savings account right now. This is not a forecast. This is not a prediction. What I am about to show you is a sequence of publicly available data points from the Federal Reserve, from the US Treasury, from the Bureau of Labor Statistics, and from the Cleveland Federal Reserve that tells a story the mainstream financial media has not assembled in one place for you. By the end of this briefing, you will understand exactly why. The United States national debt stood at $39 trillion as of April 23, 2026, confirmed by US Treasury Fiscal Data and USDebtClock.org. That number grew by $2,770 billion in the last 12 months alone. Not over a decade, not since the pandemic, in the last 12 months. Here is where it becomes structurally significant. According to Congressional Budget Office projections confirmed by Treasury statements, the annual interest expense on that $39 trillion has crossed $1 trillion. That means the United States government now spends more than $1 trillion every year simply to service the existing debt, before it builds a road, before it pays a soldier, before it funds a hospital. The Federal Reserve Bank of Cleveland publishes a real-time inflation estimate called the inflation nowcasting model. Their nowcast for April 2026 is 3.60% for the Personal Consumption Expenditures Price Index, the Federal Reserve's own preferred inflation measure. The Fed's official target is 2%. Kevin Warsh, in Senate testimony delivered on April 22, 2026, confirmed what the data already suggested. Rate cuts are delayed until late 2026. Meanwhile, the dollar index, the DXY, tracked by the Federal Reserve's H10 foreign exchange rates data, is sitting at approximately 105 and weakening. Gold is trading at $4,744 per ounce. That is a multi-year parabolic run in the asset that has historically served as the alternative unit of account when fiat currencies come under structural pressure. But to understand why this is happening now, and why the data looks exactly the way it does, we need to go back, not 5 years, not 10 years. We need to go back to 1971. Picture a German middle-class family in January of 1921. They have worked their entire lives. They have a savings account denominated in Reichsmarks. They hold government bonds. They trust the banking system because the banking system has always been there. Their 50,000 marks represent a lifetime of disciplined saving, enough, they believe, to carry them through whatever comes next. What came next was one of the most documented instances of monetary destruction in recorded history. The German government, facing 132 billion gold mark reparation obligations it could not fund through taxation or sustainable borrowing, began printing. And then it printed faster. And then it printed faster still. From 1921 to November of 1923, the German money supply expanded by a factor of approximately 1.2 trillion. A loaf of bread that cost 160 marks in 1922 cost 200 billion marks by November of 1923. That family's 50,000 marks, their lifetime of savings, could not buy a postage stamp. The number in their savings account had not gone to zero. It had simply become meaningless. The balance was still there. The purchasing power was gone. But here is what most people miss when they study Weimar Germany. There were people in that same economy who did not lose. Industrial magnates like Hugo Stinnes saw what was happening to the currency, borrowed massively in marks, bought productive real assets, factories, land, tangible property, and repaid their loans in currency that had become essentially worthless. They did not predict the future. They read the mechanism. They understood that when a government cannot fund itself through taxation or sustainable borrowing, it funds itself through currency creation. And that process transfers wealth, predictably, documentably, from savers to those who hold real assets. The Rentenmark ended the hyperinflation in November of 1923, but the German middle class never recovered. The wealth transferred during that period was never returned. Now move forward 50 years, August 15, 1971. Most Americans spending that Sunday evening did not know they were watching a monetary turning point. President Nixon appeared on television and announced the United States was closing the gold window, ending the Bretton Woods agreement that had pegged the dollar to gold at $35 per ounce since 1944. In a single address, the last hard constraint on American money creation was removed. An ordinary American family at that moment might have had $50,000 in a savings account earning approximately 4% interest annually. That was considered responsible, that was considered safe. CPI had averaged 2 to 3% per year under Bretton Woods discipline. The gold constraint had kept inflation anchored. What followed was the decade the textbooks call stagflation. CPI accelerated to 11.1% by 1974, according to Bureau of Labor Statistics historical data. By 1979 to 1980, it reached 13.5%. That family's savings account, earning 4% while inflation ran at 11 to 13%, was losing purchasing power at approximately 7 to 9% per year. By 1980, after adjusting for cumulative inflation, their real purchasing power had declined by approximately 40%, while the nominal balance looked perfectly fine. Gold told a different story. At $35 per ounce in 1971, it was the constrained asset, the thing that had disciplined the monetary system. Once the constraint was removed, gold repriced to $850 per ounce by January of 1980. That is a nominal gain of approximately 2,328% in 9 years. The Dow Jones Industrial Average, measured not in dollars but in gold ounces, declined approximately 75% from 1971 to 1980. The asset with the hardest supply constraint in that era was the asset that preserved and grew wealth. Paul Volcker ended it by raising the federal funds rate to 20% in June of 1981. It caused a severe recession, but it broke the inflation. What it could not do was return the purchasing power that had already been transferred. Now move to September of 2008. Lehman Brothers collapsed. The Federal Reserve, facing a cascading financial crisis, did something that had never been done at that scale in American history. It expanded its balance sheet from approximately $900 billion to $8.9 trillion through successive rounds of quantitative easing. According to Federal Reserve H6 money stock reports, US M2 money supply grew from $7.5 trillion in 2008 to $21.7 trillion by early 2022, nearly tripled in 14 years. An American family keeping $100,000 in a savings account during the period from December of 2008 to December of 2015 was earning near zero interest, because the Federal Reserve held rates between 0 and 0.25% for that entire 7-year window. According to Bureau of Labor Statistics CPI data, cumulative inflation during the post-crisis decade eroded real purchasing power by approximately $28,000 to $35,000 on a $100,000 holding, without a single dollar leaving the account. January 3, 2009. The same week, the Federal Reserve was implementing its emergency liquidity programs, and the global financial system was stabilizing with trillions in central bank intervention. A developer using the pseudonym Satoshi Nakamoto launched Bitcoin. The Genesis block, the very first block of the Bitcoin blockchain, contained an embedded message, a newspaper headline from that day referencing the second bank bailout. It was not subtle. The system launching in direct response to the monetary expansion was one with a fixed supply, 21 million coins, enforced by mathematics, auditable by anyone, controlled by no government. The QE era was never fully unwound. The balance sheet expansion created the $39 trillion debt trap that defines 2026, and the data from the Federal Reserve's distributional financial accounts published quarterly shows the same pattern forming right now. And now I am going to show you the specific mechanism, the exact data point that the Federal Reserve publishes, but almost no one knows how to read. Because once you see this number, you will understand why the ultra-wealthy are moving capital in the way they are right now. Let me walk you through the chain step by step, because each link connects to the next with mathematical precision. The United States national debt is growing at $2,770 billion per year, confirmed by US Treasury Fiscal Data. That is $87,685 per second, every second. Now here is where the mechanism locks in. That debt carries interest. According to Congressional Budget Office projections confirmed by Treasury statements, the annual interest expense on that debt has crossed $1 trillion, which represents 18 to 20% of all federal tax revenue. Read that again. The United States government is now spending 18 to 20 cents of every dollar it collects in taxes simply to service the interest on what it already owes. Every new $1 trillion added to the debt, borrowed at current rates of 4 to 5%, costs $40 to $50 billion per year in perpetual interest. Not a one-time payment, every year, forever. The debt is not shrinking, it is compounding, and the interest on the debt is growing faster than the revenue available to service it. This is the interest expense trap, and it explains why the Federal Reserve cannot simply cut rates to stimulate the economy the way it has in prior cycles. The Cleveland Federal Reserve's inflation nowcasting model, published publicly at clevelandfed.org, is nowcasting April 2026 PCE at 3.60%. The Fed's official target is 2%. Kevin Warsh confirmed in Senate testimony on April 22, 2026, that rate cuts are delayed until late 2026. A Middle East conflict is repricing back into energy markets. Confirmed by Reuters, polling published in April 2026. Energy shocks drive inflation. Inflation above target means the Fed cannot cut. The Fed cannot cut means the debt service costs stay elevated. The debt service costs stay elevated means more borrowing. More borrowing means more interest expense. The chain is self-reinforcing. Meanwhile, the Federal Reserve's H10 foreign exchange rates data shows the dollar index at approximately 105 and weakening. Gold, the historical alternative unit of account when fiat currencies are under structural pressure, is at $4,744 per ounce. A multi-year parabolic run in the asset that has no counterparty risk and no printing press. That is the macro chain. Now let us talk about what it means for the average American's savings. Most people believe that if their savings account balance goes up, they are getting ahead. But the Bureau of Labor Statistics data published monthly shows that the relevant question is not whether your number is higher. It is whether your number is higher than inflation. And for most Americans, the answer to that question is, it is not. Here is the arithmetic. According to Bureau of Labor Statistics CPI data, $100,000 in purchasing power in the year 2000 required $174,288 in 2024 to buy the same basket of goods. That is a 74.3% cumulative inflation increase over 24 years. Over that same period, a savings account earning the average rate, approximately 1.2% annually, compounded $100,000 to approximately $132,000. The gap between $132,000 and $174,000 is approximately $42,000. That is approximately $42,000 in real purchasing power lost, silently, invisibly, while the saver believed they were doing the responsible thing. Now let us look at the more recent period. $100,000 in January of 2020 required approximately $124,000 by January of 2026 to maintain the same purchasing power. Bureau of Labor Statistics CPI data. A savings account earning the average U.S. rate of 0.45% over that period grew to approximately $102,700. Real loss, approximately $21,300. 21 cents of every dollar, silently extracted over 5 years, with the balance looking perfectly healthy the entire time. And the current run rate, according to FDIC data, the average U.S. savings account rate sits at approximately 0.45% as of early 2026. The Cleveland Fed's PCE nowcast for April 2026 is 3.60%. The real return on a standard savings account is approximately negative 3.15% annually, guaranteed, compounding, and invisible in nominal terms. A holder of $100,000 in a standard savings account is losing approximately $3,150 in real purchasing power every single year. Most people believe that Bitcoin is a speculative asset for retail traders, but the SEC filing from Strategy dated April 20th, 2026 shows something different. Michael Saylor's company, publicly traded as Strategy, purchased 34,164 Bitcoin for $2,540 million on April 20th, 2026. That is an average price of approximately $74,338 per coin. Their total holdings stand at approximately 531,644 Bitcoin, approximately 2.53% of Bitcoin's entire 21 million coin supply. This is documented in a public SEC filing. It is not a rumor, it is a regulatory disclosure. And then there is BlackRock. BlackRock manages approximately $10 trillion in total assets, more capital than any other asset management firm on earth. Their Bitcoin ETF, trading under the ticker IBIT, currently holds 806,700 Bitcoin. That is approximately 4.08% of the total 21 million coin supply, held by a single product at a single institution. According to Yahoo Finance and verified analyst data from Phase 1 research, BlackRock's IBIT absorbed $996 million in Bitcoin ETF inflows in a single week. Most people believe that the Federal Reserve data published quarterly does not apply to their personal financial situation, but the Federal Reserve's distributional financial accounts published quarterly shows the median U.S. household net worth at $192,000 versus the mean household net worth of $1,060,000. That gap, the difference between the median and the mean, is the statistical fingerprint of what happens in an economy where savings accounts and bond instruments systematically underperform the hard assets held disproportionately by those at the upper end of the distribution. The Federal Reserve's distributional financial accounts also show that the bottom 50% of Americans own approximately 1% of all equities. When people talk about the stock market going up, they are largely describing a gain accruing to the people who already had capital, not to those contributing to 401k plans from a paycheck that is already running thin. Consider the 4 ways most middle-class Americans are positioned right now and what the official data says about each. The savings account, 0.45% interest, PCE at 3.60%, real return negative 3.15% annually. The 401k, nominal gains exist, but real purchasing power gains are reduced by cumulative inflation of approximately 24% since 2020. Cash, holding non-interest-bearing cash produces a guaranteed annual purchasing power loss of 3.60%. Compounding. Treasury bonds, nominal yields on short-term treasuries currently around 4 to 4.5%, with PCE at 3.60%. The real yield is marginally positive at approximately 0.4 to 0.9%. But after federal income tax at the 22% bracket, the after-tax real yield is approximately negative 0.4 to negative 0.2%. The instrument marketed as the safest investment in the world is producing a guaranteed real loss after tax. And there is one more data relationship I have not shown you yet. Because this is where the $39 trillion debt trap and Bitcoin intersect. Not as a story, not as a prediction, as mathematics. And this is where the macro data and Bitcoin intersect. Not as a price prediction, but as a mathematical response to a 5,000-year-old problem. Because when I looked at the Federal Reserve's H6 money stock data alongside Bitcoin's supply schedule, I found something that I think most Bitcoin holders do not fully realize about their own position. Start with 2 numbers and hold them in your mind simultaneously. From January of 2020 to April of 2026, the circulating supply of Bitcoin grew from approximately 18.2 million coins to approximately 19.8 million coins. That is an 8.8% increase over 6 years, approaching an absolute ceiling of 21 million coins enforced by open source code and distributed consensus across thousands of independent nodes worldwide. In that same period, January 2020 to 2026, according to Federal Reserve H6 money stock reports, US M2 money supply grew from $15.3 trillion to $21.7 trillion. That is a 41.8% increase. The denominator, the number of dollars in existence, expanded by 41.8%. The numerator, the number of Bitcoin in existence, expanded by 8.8%, approaching a hard ceiling. This is not a price prediction, it is arithmetic. The mathematical relationship between an expanding denominator and a supply-constrained numerator does not require forecasting, it requires arithmetic. Now consider what happened to Bitcoin's price against the backdrop of that monetary expansion. According to Bureau of Labor Statistics data, cumulative US CPI growth from January 2020 to January 2026 was approximately 24%. In January of 2020, Bitcoin was trading at approximately $7,200. On April 23, 2026, Bitcoin is trading at $78,866. That is a 995% nominal increase in the same period that the cost of living rose 24%. These are observable data points from publicly available sources. What you conclude from them is your decision. Now take a longer lens. According to Federal Reserve H6 money stock historical releases, US M2 in January of 2009 was approximately $7.5 trillion. By 2026, it stands at approximately $21.7 trillion. That is a 189% expansion in money supply since the month Bitcoin launched. Bitcoin emerged from the Genesis block in January of 2009 at effectively $0 in market value. It trades today at $78,866. The observer can track both data series without being told what to conclude. The institutional accumulation data tells its own story. Strategy's 531,644 Bitcoin, documented in a public SEC filing, represents approximately 2.53% of the total 21 million coin supply held by a single corporate treasury. BlackRock IBIT's 806,700 Bitcoin represents approximately 4.08% of the total supply held by a single ETF product. Together, those two institutions hold approximately 1,338,344 Bitcoin, approximately 6.38% of the entire fixed supply, with weekly inflows running at $996 million per week, according to Yahoo Finance and verified analyst data. These institutions did not arrive at these positions by accident. They arrived through documented investment thesis frameworks. Saylor has stated publicly across multiple earnings calls that Bitcoin is the only verifiable fixed supply asset in a world of structurally expanding fiat money. BlackRock's product documentation references Bitcoin's supply schedule as a core characteristic of the asset. These are not retail sentiment plays. They are structured allocations by the institutions managing the largest pools of capital on Earth. The historical pattern across all three eras I walked you through, Weimar Germany, the 1970s stagflation, the post-2008 QE era, shows a consistent sequence. Fiscal constraint, meaning debt service consuming an outsized share of government revenue, precedes monetary pressure, meaning the central bank cannot raise rates fast enough or cut rates to provide relief. Monetary pressure precedes persistent inflation above target. Persistent inflation above target precedes capital rotation into the fixed supply asset that serves as the available alternative unit of account. In the Weimar era, it was physical goods and foreign currency. In the 1970s, it was gold, from $35 to $850 per ounce in 9 years. In the post-2008 era, it was both gold and Bitcoin. In 2026, the U.S. interest expense has crossed $1 trillion annually. The fiscal constraint signal is active. The hardest supply constraint mathematically verifiable in 2026 is 21 million coins. The Federal Reserve publishes the money supply data monthly. Bitcoin's supply schedule is public and auditable by anyone on Earth. This is what the data shows. The Federal Reserve publishes the money supply data monthly. Bitcoin's supply schedule is public and auditable by anyone on Earth. What you do with the relationship between those two numbers, that is your decision, not mine. In the next few minutes, I am going to give you the 3 data points we track every single week at the macro signal. The same indicators that give us early warning before the mainstream media catches up. Write these down. These are not opinions. These are not forecasts. These are publicly available, official government and central bank data sources that tell you, in real time, what is happening to the monetary environment before the mainstream financial media assembles the story for you. Each one is free. Each one requires no subscription. Each one is updated on a regular schedule. And each one tells you something the others cannot. The first signal is the Cleveland Federal Reserve Inflation Nowcasting Model. The Federal Reserve Bank of Cleveland publishes a real-time personal consumption expenditures estimate, the PCE index, which is the Federal Reserve's own preferred inflation gauge, updated monthly, available to anyone at clevelandfed.org. Search the phrase inflation nowcasting. No login required, no subscription, no paywall. As of April 2026, the nowcasting model is projecting 3.60% PCE, 1.6 percentage points above the Federal Reserve's official 2% target. Here is why this matters. The Cleveland Fed's nowcast gives you the inflation reading before the official Bureau of Economic Analysis PCE release. If you wait for the official number, the financial media has already priced the reaction. If you watch the nowcast, you see the direction the number is trending in real time. What you are looking for is the gap between the current nowcast and 2%, because that gap is the distance between the current environment and the environment in which the Federal Reserve can cut rates without reigniting inflation. As of April 2026, that gap is 1.6 percentage points. If the nowcast rises above 4%, rate cuts become structurally impossible and the interest expense trap deepens. Every new month of borrowing at current interest rates adds more to the $1 trillion annual interest bill. If the nowcast falls below 2.5%, the Fed gains room to reduce rates, which would temporarily relieve debt service costs, but which historically precedes renewed currency debasement as the cost of money falls and money creation accelerates. The second signal is the US Treasury Department's daily Treasury statement. The United States Treasury publishes a daily Treasury statement, updated every business day, available at fiscal.treasury.gov. Select Daily Treasury Statement. No login required, no subscription. What this document shows you, updated every single business day, is the daily cash position of the U.S. government, daily receipts, meaning how much tax revenue came in, and daily outlays, meaning how much the government spent, broken down by category. The specific line item you are looking for is labeled Interest on Treasury Securities, Public Debt Cash Outlays. When the U.S. government is paying over $1 trillion per year in annual interest expense, the daily run rate on that line item is approximately $2.7 billion per day. That is the number to hold in your mind. If you begin watching the daily Treasury statement and that line item is consistently running above $2.7 billion per day, the annual interest expense is tracking at or above $1 trillion, active and worsening. If it begins consistently exceeding $3 billion per day, the annualized interest expense is tracking above $1.1 trillion, crowding out more discretionary federal spending and creating greater structural pressure toward financial repression as the government's most viable exit mechanism. Financial repression, allowing inflation to run above interest rates so that the real value of debt erodes over time, is option 3 in the government's fiscal playbook. Option 1 is default, which is politically catastrophic. Option 2 is real GDP growth outrunning debt growth, which requires the economy to grow faster than $2,770 billion per year. Option 3 is inflation running above the cost of debt in real terms, which transfers purchasing power from creditors and savers to the sovereign. The daily Treasury statement is the instrument that lets you track in real time which option the math is pushing toward. The third signal is the Federal Reserve's H6 Money Stock Report. The Federal Reserve publishes the H6 Money Stock Measures Report weekly, released every Tuesday, available at federalreserve.gov. Search H6 Money Stock. No login, no subscription. This report tracks M1 and M2 money supply. M2 is the broadest practical measure: cash in circulation, checking accounts, savings accounts, money market funds, and small certificates of deposit. As of the Federal Reserve's most recent H6 release in 2026, M2 stands at approximately $21.7 trillion and is resuming its growth trajectory after a brief contraction period in 2022 and 2023. The number you are looking for in the H6 is the seasonally adjusted M2 monthly rate of change, annualized. When M2 is growing at more than 3 to 4% annually, above the Fed's 2% inflation target, money supply expansion is structurally inflationary regardless of what the Fed says in press conferences. Monetary policy statements describe intentions. The H6 report describes what is actually happening to the money supply. If the weekly H6 release shows M2 growing above 4% annualized, while the Fed is simultaneously delaying rate cuts, that is the signal that real purchasing power erosion will continue. Not because anyone announced it, because the mechanism is operating. The denominator is expanding. The purchasing power of each existing dollar is diluting. The H6 is the instrument that lets you measure the pace. 3 signals, 3 sources. All free, all official. The Cleveland Fed Nowcast tells you how far the Fed is from cutting rates. The daily Treasury statement tells you how fast the interest expense trap is deepening. The H6 tells you what is actually happening to the money supply, regardless of what official statements claim. Watch all 3 in sequence. When all 3 are moving in the same direction simultaneously, rising nowcast, rising daily interest outlays, rising M2, that is the macro environment the data in this video describes. That environment is, as of April 23, 2026, the environment you are currently in. Here is what the data shows. The United States national debt is growing at $87,000 every second. The interest expense on that debt has crossed $1 trillion annually. 18 to 20% of all federal tax revenue spent before a single road is built or a single service is funded. The Cleveland Federal Reserve is now casting 3.60% inflation for April 2026. Kevin Warsh confirmed in Senate testimony on April 22, 2026, that rate cuts are delayed. The dollar index is weakening. Gold is at $4,744 per ounce. History documents this sequence. Weimar Germany, the 1970s after Nixon closed the gold window, the decade after 2008. In each case, fiscal constraint, then monetary pressure, then persistent inflation above target, then capital rotation into the asset with the hardest supply constraint available. The assets that preserved wealth in each of those eras were the ones that could not be printed. The savers who trusted the nominal balance, the number on the statement, discovered that the number and the purchasing power had quietly diverged. That divergence is the mechanism. It is not new. It is not a theory. It is a documented pattern across 3 of the most consequential monetary periods in modern history. The 3 signals to watch this week: the Cleveland Fed Inflation Nowcast, the daily Treasury statement, the Federal Reserve H6 Money Stock Report. Disclaimer: this content is for informational and educational purposes only. Nothing in this video constitutes financial, investment, or legal advice. The macro signal is not a registered investment advisor. All data cited is from publicly available official sources. Always consult a qualified financial advisor before making investment decisions. Bitcoin and all cryptocurrencies carry significant risk of loss. The macro signals we track here are public data. What is not public is how to read them in sequence, and what they mean for your purchasing power when they converge. That is what we do here every single week. If that matters to you, subscribe, because the next signal is already forming.